Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, January 31st, 5:34 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're in an uptrend since the follow-through days, the beginning of November. Coming under some pressure now, though. You can point the finger directly at Jerome Powell, or can you point it at the markets who didn't seem to be listening to him? The reason why it doesn't really matter. What matters is the price, because that's the scoreboard and that's all that we get paid on. But we'll check the trend gauge to start off with. Leaders acting fine, a little bit of pressure today along with basically everything else. Short term, two of the major indexes, the small caps and mid caps, broke below the 21-day moving average today. So we got the yellow sub arrow out to indicate that. All five of the major indexes still trending above their medium-term 50-day moving average and their long-term 200-day moving average. So what happened today? Well, we started with a weak open on some poor reactions to tech earnings after hours on Tuesday, namely AMD and Google, and to a lesser extent, Microsoft. And we spent the morning in the red, but improving into the 2 o'clock. And then the initial statement from Powell was perceived as hawkish. As the press conference went along, there was a strong rally until somebody asked him a question about, he was talking about he needed to be confident that inflation was under control. And one of the questions to him said, how much longer do you need until you're confident? It's been 6, arguably 8 months that inflation has been under 2%. So how much time do you need? And he said, well, it's not likely that we're going to do a rate cut in March. And that was it. That triggered the sell-off, harsh, down from near the highs of the day, and we end up over the last hour and 10 minutes going down to the lows of the day. So here are the final numbers, and they're not pretty. The big seven down an average of 2.7%. RG8, this is our 8 growth ETF composite, down 2%. S&P down 1.6%. Equal weight, S&P 500 down 1.3. NASDAQ 100 down almost 2. Equal weight down 1.4. Dow Jones Industrial Average down 0.8. Mid caps down 1.9. Russell 2000 small caps down 2.5. Global diversified 60/40. Bonds were the safe haven today. I'll get to that in a second. Well, I'll get to it now. The reason was one of the regional banks that bought one or two of the other weak regional banks, NYCB is the ticker, got blown apart on earnings. And that sent some fear right before the open. That added to the fears in addition to the weak tech earnings, and that really dragged down regional banks all day today. And that contributed to a flight to safety into bonds, and bonds were up today. And that's why Global 60/40 outperformed, down 0.66%. In-house GROTECTION, we took a hit both on our index positions and on some of our leaders, got stopped out on a few things, down 2.49% on the day. Let's get into the details. We'll start with the S&P 500 here, and you can see this bar indicates a big change in character for not only the gap down, but then also the size of the bar, break of the 8-day exponential moving average, and it definitely has our attention. We got more defensive today, put a hedge back on, got stopped out on a couple of things. The reason is we know from prior history when when the markets disagree with him, that it tends to be the time when stocks come under pressure until they get more confident in whatever. I don't know exactly what, until they find their level. It's like water. They need to find their level where it stops flowing downhill. For now, we don't get overly defensive until we break our short-term green line here, the moving average, the 21-day moving average. Then the other line in the sand for us is the 50-day moving average, and then we're kind of extremely defensive between the 50-day and the 200-day. And the 200-day, we don't want anything to do with the market whatsoever if we're underneath there, because that's where all bear markets take place throughout history. No need to panic, but it's a time to be prudent, is what we'll be doing, and making sure that our stops are in place. Our maximum loss from here is less than 4% based on an analysis of our balance at risk where all of our stops are, and that's a very reasonable um, loss to the downside before we really kind of put the brakes on more firmly. But for now, we monitor our stocks, get rid of anything that is not profitable or is not acting uh, like a leader. A couple things did that today, but today is definitely one of the more difficult days to trade when you're an active investor because you're at the mercy. I mean, there's no way to trade this. Okay, you come in, you set your stops, you look for things that are going to underperform, but uh, in an erratic day like this, and we know growth stocks already are 2 to 3 times at a minimum more volatile than the market is, but harsh plunge down, big rally to the upside, and then this big sell off from 49.05 to 48.50. Uh, and stocks moving down 3, 4, 5, 6% off of their highs, all you can do is set your stops and wait for the market to come to its senses. And a lot of people say at that time to buy is when there's blood in the streets and you should have been buying this. But we've seen too many times that a hard break off the top is the first time that it's the first indication that you need to get more defensive. And that's what we'll be doing as the next couple of days unfold. It's the day after very often is extremely important after the investment community, the market has a chance to absorb what Powell said, consider that we're not going to get a rate cut in March. We still have about a third a chance, I think. So if that's the case, we're just ignoring Powell, or we're banking on weaker economic data. But the economic data has been strong, and that's one of the reasons why he wants to stick to this, what he's been saying all along, until they're sure inflation is under control. They're not going to uh, cut rates because Volcker made that mistake back in the 70s, and he doesn't want to repeat it. NASDAQ 100, very similar, closer to the 21-day exponential moving average, down almost 2% on the day. The most defensive of the big cap index is the Dow, only down 0.8%, still above the 8-day exponential moving average and the 38,000 level. Rising rate, and rates did not rise today. Rising rates are bad for the small caps and mid caps, especially small and mid growth. But yields were down today, but it was because of a perceived flight to safety. There was a lot of moving parts today, and it's hard to draw a conclusion from just one day. So in a lot of cases, we'll just watch what's going on. But we're now down near we broke below the bottom of this 7-day range where we were consolidating on mid caps, and now arguably you can say it's a failed breakout on small caps, which broke above and now below that same consolidation and closed below the 21-day moving average. Looking at the VIX with a volatile day did spike up 7.8%. It's above the 21 and the 50-day moving average, still below the 200-day and below that 15 level that we monitor. The dollar was weak early, gathered strength after Powell into the close, as you can see, doing the complete opposite of what the markets were doing. How did that impact gold and silver stocks? Well, early gold was strong. It pulled back to flat. GDX, gold stocks, were strong early, pulled back to being down 0.75%. Bitcoin on the day down. It pulled back down 2.4%. Now let's go over to bonds. Look at yields. This is the broad bond index. We gapped up. Gap up on bonds, meaning prices up, yields down. And again, some of this was the panic. And then volatile in the afternoon along with stocks. Can't draw a conclusion to this, but for now, yields end up the day higher, even though Powell says he's delaying cuts. But until this New York Community Bank thing, NYCB, shakes out and there's more confidence. This is the first time that one of these regional banks, at least in this earnings report, has gotten blown apart. Let's take a look at the chart of it very quickly, and you can see the big gap down ends up down 37.7%. So not good, obviously. TLT, the long bond, price up on the day. That means yield down. TYX, broke below the 200-day moving average and the 50-day moving average. This is normally supposed to help out stocks, but as I said, maybe a flight to safety, considering New York Community Bank, and then also a sell-off in the tech names. So that's our inter-asset correlation. Let's go quickly to the tail of the tape. Not likely to cut in March really is the story of the day. Down 1 on the day count, first close below the 8-day exponential moving average, 18 days above the 21. The only things positive today were the dollar and ITA, aerospace defense. 11 out of 11 sectors down, led by regional banks, oils, and software. So our stops got hit in-house on Datadog, Snow, and SOXL, and we bought SQQQ as a hedge. Also tomorrow, as if there's not enough going on this week, we've also got Amazon, Apple, and Meta reporting after hours. So that's more of an impact to the market, as much or more as last night was with AMD, Google, and Microsoft. So this dropped our exposure from 1.85 to 1.38. We'll take a look at some of these charts in a minute, but the bottom line, gap down on tech earnings in the morning, and then Hawkish Powell triggers end of day plunge. It is what it is, you know. You can't ever say yeah, but because the market is the scoreboard. Let's start off with what we got stopped on. Datadog. We almost got stopped last week on it. Got back above the 21, but as I had been mentioning, and it actually kind of outperformed today. You can see it. We sold it when it undercut the 21-day. Actually closed the day back above the 21-day moving average. So showed some relative strength today. Sure wasn't showing relative strength last week with these 2 big day sell-off, but maybe for whatever reason somebody just needed to get the heck out. But anyway, we're out of the position now. Small loss. Also out for a small loss on Snow. As it broke the 21, volume picked up. This was acting great, but all these leading software stocks took a hit today after showing some strength on Monday and late last week. Let's take a look at the rest that we're holding. Not quite hitting our stop, but also not, but very close to getting hit is a firm. It's a volatile stock in the first place, a 7% ATR, down 5% today. It was showing some relative strength early and gave it up toward the end as the baby was thrown out with the bathwater. AMD, great, not a great reaction, not a good open, but great bounce off the 21-day moving average and closing at the top of the range. After all things were sorted out with its earnings report. NVIDIA just bounced at the 8-day exponential moving average, continues to be very strong. NVO gapped up. Sister stock Lilly also ended up positive on the day, although off the highs and on heavy volume. Uber showed a lot of relative strength, but then did close below the 8 EMA, down 2.35%, but look at average volume, 47% below average. That's our largest position right now. CrowdStrike also showed some relative strength until late when it sold off, broke the 8-day exponential moving average, down 2.9%, but on 26% below average volume. Did I hit everything? I believe I did. All the individual positions that we own anyway. SOXL, we'll look at SOX. Sold hard, did bounce off the 21, but originally we were just giving it below the low of the day when we got stopped out, and then gave it a little bit more room before finally getting stopped out. What else do we want to look at here? Some things that underperformed or outperformed. SMCI continues to be a beast, holding that 500 level on a down day today. It was positive all day. On the other hand, on the weak side, ANET, breaking the 8-day exponential moving average on double average volume. GTLB, which had been acting extremely well, just sitting on the 8-day exponential. Anything that's still above the 8 after a day like today is absolutely showing leadership and should go to the top of the list as far as stocks that are holding up. Not necessarily saying buy them, but you want to be aware of what is holding up relative to what's going on with the market. Let's see, NET. Also pulled back, broke the 21 and the 50-day moving average on above average volume. So take stock of take stock of your stocks, and especially from a relative strength standpoint, what held up today. Those are the ones to focus on if the market ends up not throwing a tantrum on what Jay Powell said today. Could be a one-day thing, could be a couple of week pullback, could be a change in character for the market. February is very often an iffy time overall from a seasonality standpoint, and we are aware of that. And with that, I'm going to wrap it. As always, like to hear from you. The email is don@revereasset.com. The phone's 855-REAL-WEALTH. That's 855-732-5932. If you're interested in becoming a client, email my partner, Dan Stewart, dan@revereasset.com. Our flagship portfolio is named GROTECTION because we grow assets during uptrends and protect them when the market is risky. First sign of a risky market is a break below our short-term trend indicator. That's a 21-day moving average, then the medium-term 50-day moving average, then the long-term 200-day moving average. The health of leading stocks and the indexes above these three levels indicates how much money we have at risk in the market. And with that, I'll wrap it up for Wednesday, January 31st. Not the way we wanted to close the month, certainly, but still positive for the month on the S&P and our accounts in-house. Thanks for listening, and have a great day.